Hi, my name is Rajiv Rebello. I'm the Principal and Chief Actuary of Colva Actuarial Services. And today we'll be talking about how do I increase my risk-adjusted portfolio returns and minimize taxes as I plan for retirement. So this is a four-part presentation. And in this part of the presentation, part one, we'll be talking about how are stocks and bonds used in portfolio management. And this will be an important part because you really need to understand the role that these two play in traditional portfolio management in order to understand how you can kind of utilize various financial planning tools to maximize your returns, right, and minimize taxes. So we'll be talking about in later sections how stocks are more tax efficient and higher earning than bonds and how you can utilize that to your benefit. But in order to get there, we have to start with the basics, which is just understanding how stocks and bonds are used in portfolio management. So that'll be the focus of this part one of 4 of our presentation. I will link to the parts 2 through 4 in the description below. So let's just go over an overarching agenda for our presentation on how do I maximize risk-adjusted returns and minimize taxes as I plan for retirement. I'll just go over the different topics we'll be talking about in this presentation and what part of 4 you can find this topic in our presentation today. So the first subject we'll be talking about, what are the role of bonds in a portfolio? So that's going to be in part 1, and we'll just see that bonds provide stability. They're lower earning, but they also provide less volatility, so less up and down movements in your pricing. So if you worry a lot about monitoring your portfolio, that's kind of where bonds are, is they reduce the up and downs of your portfolio. What are the role of stocks in a portfolio? Again, that's in part 1, and we'll see that the stocks is where your main growth is of your portfolio, and it's very tax efficient, as we'll be talking about, especially if you're looking to pass on generational wealth. You can really minimize, the tax drag of your portfolio by using stocks or equity. In part 2, we'll be talking about why stocks are higher earning and more tax efficient than bonds. So that's really going to be of interest and a key part of this presentation. Again, that'll be in part 2. In part 2, we'll also be talking about the problem with retirement models and retirement accounts for high net worth clients and why traditional models over allocate to bonds, even though bonds are lower earning and not as tax efficient as stocks. So that's, again, a very important part of the section. We'll then be talking about in part 2, well, if bonds are so tax inefficient and lower yielding, why do advisors and target date funds increase allocation to bonds as clients get older, right? So why are they doing that if we know that stocks are higher earning and more tax efficient? And we'll talk about why that model benefits the advisors more so than it does the actual client. And you'll see this if you have 401ks or just Vanguard target date retirement funds. You'll see this increasing allocation of bonds and why it's actually a problem for clients, even though it's better for the advisor's model. In part 3, we'll be talking about what is protected investing and why does it have higher after-tax returns and less volatility than bonds. So in this earlier parts of the presentation, we'll be talking about how bonds have less volatility, but they're also lower earning and less tax efficient. Well, protected investing offers, a win in both worlds, right? You're getting higher after-tax returns and less volatility. So we'll be talking about why you really should look at protected investing in place of bonds in part 3. And part 4 is probably, the most interesting part of the presentation and something that, everyone should be utilizing is why is borrowing against my stock portfolio in retirement more valuable than taxable withdrawals? And so this is going to be a key element because if you're looking to retire early or maximize the wealth you pass on to beneficiaries, this is a key component because the traditional retirement model of over-allocating the bonds, lowers returns, increases taxes, and then when you take taxable withdrawals, it really creates a lot of drag, as we'll be seeing in our case example. So using a pure stock portfolio and borrowing against it for your withdrawals in retirement can both generate a lot more wealth for you in retirement, generates a lot more wealth for your beneficiaries after you pass on, and reduces the overall tax drag of the portfolio. So we'll talk about why this is a huge key advantage you should be using. Finally, we'll talk about how you can pay 0% in taxes in retirement. Again, this will be in part 4. So if you do have large gains and if you do want to use taxable withdrawals, right, instead of borrowing, then you really should plan it, use proper financial planning and take it out when you're at a 0% tax bracket. We'll talk about the importance of doing that later on. As I mentioned, I'm the chief actuary of both Colva Actuarial Services and Colva Capital. Colva Actuarial Services is an actuarial and insurance servicing company. that really works with high net worth clients and registered investment advisors or financial advisors. And we really we're the math guys to show them how to utilize better after tax, after advisory fee returns for their clients, right? How do we use protected investment vehicles to better enhance their clients' portfolio returns, right? So just a lot of education about math and kind of vehicles and showing them why it makes sense for the client. Colville Capital is a registered investment advisory firm. We help investment groups invest in alternative assets. So if you're looking at markets and you're seeing both stocks and bonds, have decreases, and you want to diversify your portfolio with alternative assets, we help registered investment advisors and high net worth individuals accomplish those goals of better portfolio diversification. Also implementing more tax efficient vehicles for their high net worth clients. So now let's talk about the use of bonds in a portfolio. Before we get into that, just for everybody, I'm not sure what your level is of investing. Bonds are, when you invest in bonds, you're simply lending money to a company in exchange for interest payments over time, right? So if in the opposite example, if you have a mortgage, you're borrowing, right, from a company, which is the bank, and then you're paying interest on that. This is the reverse, right? In this case, you're the one doing the lending. You're essentially the bank. You're giving money to the company, and they're giving you interest payments over time. So the benefits of bonds in a portfolio are they're less volatile than stocks. And when I say less volatile, that means you'll see less up and down movements in the portfolio if you're investing in bonds. We'll show that in a graph later on. Another benefit is that in the right environments, not in the current environment we're in, but it can add diversification to a stock portfolio in high yield environments, right? Not in low yield rising environments, which we're in now. So you're seeing losses in both bonds and stocks. The other advantage of bonds in a portfolio is that it provides steady yearly income stream, right? So you're getting a steady coupon payment and cash coming in. You're not kind of investing purely for the long term. You're getting yield essentially. So now let's talk about the disadvantages of having bonds in a portfolio. Well, the first and main one is that it's lower expected returns than stocks. So over the long term. So we'll be seeing this in the next few slides. So you have lower expected returns, but in exchange, you're getting the lower volatility. So you're not seeing it go up and down as much, but you're also getting lower returns, right? So that's the pro and con. You're getting a benefit of less volatility, but the con is that there's lower returns, right? Another con is that you pay taxes every year on the gain. So you're not really getting tax deferral if you're investing in bonds, of course, unless it's in a tax deferred retirement account. So again, there's two huge knocks, is that it's lower returns and you're paying more taxes on the gains than if you were to invest in stocks. Again, these taxes are subject to your ordinary income rate. So if you're a high earner in a high, tax state like California, you can be paying 50% or more on these taxes on an already lower yielding asset, right? So again, you're paying more in taxes on a lower yielding asset. It's not adding as much benefit to your portfolio. And of course, it will lose money. Investing in bonds will lose money if interest rates rise. So it's not a guaranteed safe investment. It is subject to losses. And so when you combine all these three things, it creates a drag on the portfolio, as we'll be seeing in a second. So just to summarize, bond investing has lower volatility, but also lower expected after-tax returns. So now let's go on and talking about stocks, the pros and cons of including stocks in your portfolio. First, let's just talk about what are stocks, or essentially equity. And when you invest in stocks, it's different than bonds, right? You're not lending money. You're essentially owning a small part of a larger company. So let's talk about the benefits of stocks in a portfolio. The first is that you're having higher long-term returns, right, than bonds. And again, we'll show the graphs later. The next key point is that you can defer taxes until you sell the stock or realize gains. And then there's a huge benefit of tax deferral, which we'll show again later on, that you don't really get with bonds. Another huge advantage is that there's a lower long-term capital gains tax rate. Again, it can be anywhere from as low as 0% to 37.1% currently in California. Again, the higher income you're earning, the higher tax rate you're going to be in. And the risks of investing in stocks can be diversified by buying multiple stocks, or known as index investing. So now let's talk about the disadvantage of stocks in portfolio. So when you invest in stocks, there's higher short-term risk. So again, there's more volatility, so the price can go up and down a lot. So if you're investing for the short term, it's can be very risky, right? Long term, not as much, but again, you're getting the advantage of higher long-term returns, but you're paying the price with a higher volatility relative to bonds. So when we compare stocks to bonds, stock investing has higher long-term returns than bonds and are extremely tax efficient, but investors have to be okay with short-term volatility and investing for the long term. So the next step of this presentation is essentially to look at both stocks and bonds in two environments. One is kind of a subdued environment, or where stocks aren't doing too well, and then we'll look at it in a what's called a bull market, or an environment where stocks are doing really well. So I've chosen two periods here. One is a subdued, volatile equity market. I'll be looking at, we'll be looking at the period between 2002 to 2011, where stocks, didn't do all that great. And then after that, we'll be looking at, 2012 to 2021, where stocks really did well. We'll see the differences in the key, the pros and cons we talked about in the previous slide will really come to light here. So just real quick, we have a graph of between 2002 and 2011. The stocks are, is the blue line. We're just tying it to the index with the S&P 500, which is the total return. You can follow this yourself if you want. You can get the data. The ticker is VOO. The bonds, we're just tying to the AG, which is just a bond benchmark. And that's in red here. And a couple key things, if you're just interested in portfolio management, you should always tie your returns to benchmarks. So your equity return should be tied to a benchmark like the S&P 500. Your bond return should be tied to the AG, something like the AG. So it's a good way to kind of, evaluate, your financial advisor or your investment portfolio and evaluate those returns relative to a benchmark. So the first thing we're going to see we're going to look at stocks first. We can see that stocks, in the early 2000s, didn't do too well. Like was in 2002 was, the loss was greater than 20%, right? So it was negative. Then we can see a huge jump in 2003, and then we can kind of see, obviously, in 2008 there was a huge, the financial crisis, and then 2009 jumped back up. So we're seeing that, stocks go, the what we call the volatility as it goes up and down is high, right? And it's being hurt a lot by this huge, loss here in 2008. So when you look at stocks, from the period of 2002 to 2011, again, we're using the VOO as the benchmark. The pre-tax return was only 2.7% during this period, this 10-year period. And obviously it's low because of this huge loss here in 2008. And then again, the volatility is just a measure of how much it goes up and down as a percent. So this 20.57%, again, higher number here means it jumps up and down a lot, which we can see it goes up and down with a lot of volatility, especially due to this 2008. The Sortino ratio is just a way of measuring, return relative to risk. So we can see here in this, again, the higher number here means there's higher return relative to the risk. The lower return means there's lower return relative to the risk. So in this case, the 0.05 means that the risk is a lot higher than the return, right, on a value basis. And again, this is pre-tax. When we look at bonds, again, the red line, what we see is that the returns are a lot lower, but guess what? It's also more stable, right? It's, again, under 10%, never going above 10%. But again, you're not seeing the huge losses either, right? So if we look at the pre-tax return over this period, we can see that the bonds are about 5.51%. The volatility, look how low the volatility is. It didn't, it's not hugely aggressive here. It's not jumping up and down a lot. It's very low. So when we look at the return relative to the risk, it's 2.23, which is significantly higher than stocks over this period. So just to summarize, in a subdued equity market, volatility can hurt portfolio drastically, right? So if it's going up and down, like especially if you have huge losses like we did in 2008, it can really hurt your portfolio. Another thing is that in a higher interest rate environment, like we were in 2002 to 2011, bonds can add value to your portfolio. They can be a good diversifier of risk and provide stability in your portfolio. So now let's look at a period when stocks did really, really, really well. So stocks and bonds in a bull equity / low interest rate decade, right? So here we're looking at 2012 to 2021. We're looking at stocks and bonds, and we're going to do the same comparison. We're looking at the S&P 500 as our benchmark, and bond returns are the ag, again, the red line. So the first thing we're seeing is that, stocks from 2012 to 2021 barely have any negative years. It's really just 2018 where it did negative. It was slightly negative. So it's a huge bull run. So if you were invested in stocks, you did really, really well over this period. And this is reflected in these metrics over here. From 2012 to 2021 on a pre-tax basis, stocks, the VU was about 16.39%. The volatility was 12%, which was significantly less than what it was in the previous decade, right? So when we look at our Sortino ratio, it's high, it's humongous. The return relative to risk is huge over this period. Bonds are another story. Bonds, the interest rates were low during this period, and the reason why is because the Fed, purposely suppressed interest rates so that the economy did well. So it accomplished that goal, right? They kept interest rates low, which means everybody wanted to invest in the stock market because interest rates were too low. So it was a great alternative. But the downside is that bonds really didn't have much value, right? So again, we see lower volatility, but the returns are really low too. 2.81% on a pre-tax, compounded basis. Again, the volatility is low, but when we look at our Sortino ratio, which is our return relative to risk, it's really low. So it's the reverse of what we saw in the previous decade, right? So the key things to take away here are that in a bull market, stocks vastly outperform bonds, so the volatility is worth it. So this volatility is well worth it for these returns, right? And low-yielding bonds are easy to outperform, right? The interest rates were held low, so the alternative was to invest in stocks, and stocks took off, largely because of the low interest rate environment. So now let's look again at let's put everything together. Look over the entire 2002 to 2021 period, again, just on a pre-tax basis. We can see stocks are, again, volatile. A huge loss in 2008, but up and down, large up and down from year to year. We see lots of volatility. Bonds, again, are more stable. So when we look at this, we're essentially seeing the entire period stocks, over the 2002, if you're investing for the long term, you made about 9.33%. This was the volatility here. Again, the pre-tax Sortino ratio is 0.69 because, again, you had the good decade or the bad decade, and then you had the great decade, right? Bonds, you had the opposite. They had the good decade and they had the bad decade. So here's the risk relative to the return. Again, you're getting more return here with stocks, but again, you're taking more risk. Bonds, you're getting less return, but you're getting less risk. So stock investing over the long term has higher returns, but you have as we'll talk about later, are more tax efficient. But you have to be okay with this volatility. So in subsequent sections, we'll be talking about, well, how do I minimize the risk part of it? You kind of want the best of both worlds. You want the higher returns, but you don't want as much risk. So how can we kind of compromise and get a portfolio solution that makes sense for us and our risk tolerance? So in this section, we'll be talking about why are stocks more tax efficient than bonds, and why do current retirement models benefit advisors more than clients? So this is part 2 of our series on how do I increase my risk-adjusted portfolio returns and minimize taxes as I plan for retirement. If you're interested in other parts of the series, we'll link that in the description below. So let's dive right in and talk about, first of all, why are stocks a better risk-adjusted and tax-efficient investment than bonds? The first reason are that stocks are taxed at lower capital gains rates. As we talked about in part 1 of the presentation, this can be as low as 0% and as high as 37%. But they're significantly lower than ordinary income rates. Another huge benefit to investing in stocks is that stock gains can be deferred until the client is in a lower tax bracket. Again, if you do this properly and you want taxable withdrawals, you can take out your gains at a 0% tax rate in retirement, up to about $100,000. Another huge advantage is when it comes to generational wealth planning and passing on wealth to your beneficiaries or your kids, is that A huge a benefit of investing in stocks is that stock gains can be deferred and passed on to beneficiaries tax-free through step-up in basis. Again, 0% if beneficiaries inherit it. So there's ways to utilize stocks from a financial planning perspective that allows clients to get higher after-tax returns and the ability to pass on wealth tax-free to the next generation that you really can't get with investing in bonds the same way. So we're just going to look at real quickly a simplistic math example about how investing in stocks can provide a better risk-adjusted return for the long term when we account for both the higher returning potential of stocks as well as the higher tax efficiency of stocks. So let's just do a quick comparison between stocks and bonds. Again, we're assuming that stocks are higher returning because over the long term, stocks have earned about 10%. We're assuming in this case the gross return is a little less than 10%. We're assuming 8% over the long term, and we're assuming bonds are at about 3.5%. And as we mentioned, we can't just look at the gross return. We have to look at how those returns are taxed. So it's important to consider what's known as your marginal tax rate. Again, we're going to make assumptions here for a couple. We're going to assume it's a California married couple making about $450,000 per year. So the marginal tax rate on this couple for stocks is about 33.1% for the long-term capital gains rate, and you can see how that's broken down here. On the bonds, again, that's taxed at ordinary income, and then that's about 45.3% for this couple, and then again, we've summarized that down below here. So as we can see the two key components that I was trying to highlight here is that stocks are higher returning and you pay less taxes on the gains. And again, you can defer taxes and pay 0% if you pass it on to your beneficiaries or close to 0%. Whereas bonds are lower returning, have a lower gross return, and they're taxed higher. So the key thing to keep in consideration here is your after-tax return, right? So what are you really making from these assumptions on an after-tax basis? You can see that stocks, you're making about 5.35%, whereas bonds, you're making about 1.91%. Again, we talked about bonds have less volatility, but that's short term. But over the long term, right, you're getting higher after-tax returns. So if you have a longer time horizon, investing in stocks properly can both provide numerous advantages to both you as a client and your beneficiaries, as we'll talk about in this upcoming section. So now let's kind of quickly talk about the benefits of tax deferral. One of the things we mentioned in the previous slide was that stock gains, you can defer the taxes. You can defer it again almost indefinitely till you die and you pass it on to your beneficiaries, or you can defer it until you sell actually the asset. So we're going to go through a quick example about how that works. So we're going to use a hypothetical individual. John Smith decides to invest $100,000 into two index funds that earn 8% each year for 30 years, and they're both subject to John's marginal tax rate. John's total marginal tax rate is 50%. So these are a simplistic case example just to show you the benefit of tax deferral. So index fund A requires the client to pay taxes on the gain at the end of each year. So there's no tax deferral here with index fund A. Index fund B allows the client to defer all gains until the end of the year. Again, the gross return is 8%. The marginal tax rate is 50%. So kind of let's do a comparison between fund A, which is no deferral, and fund B, where you can defer all the gains for 30 years. And in both cases, the gross return is 8%. So when you look at fund A with no deferral, the net gain is only $4,000, and the reason being is you're losing 50% of this 8% gain due to taxes. So the after-tax fund value at the end of 30 years is $324,000, right? And the 30-year, after-tax, the compound annual return is 4%. And that makes sense, right? Because you're losing 4% each year due to the taxes, so your after-tax return is 4%. However, if you can defer all the gains, what happens is each year you're getting the full $8,000 gain. You're not paying taxes. You don't have a tax drag each year, and excuse me. And that's also compounding. So that $8,000 is being added to your principal, and it's compounding. And yes, you do pay taxes at the end of 30 years, but you have the benefit of compounding during that 30 years. And we can see that the benefit of this is that after 30 years, you have $553,000, which is, more than $200,000 more than if you had no deferral. So when we look at a 30-year after-tax return, it's 5.87%. So by utilizing a fund that allows you to defer taxes, you're making almost 2% more simply by deferring the gains. And the whole point being is that to illustrate the value of tax deferral and how stocks can allow you the benefit of deferring tax gains, and how when you construct your portfolio and you're doing financial planning, right, to utilize this properly can result in a huge differential in wealth for both you as the client and your beneficiaries who will inherit it. And bond return taxation behaves more like Fund A. So when you're investing in bonds, you're going to see, again, you're getting taxes every year, whereas stock return taxation behaves more like Fund B, where you can defer most of the taxes. Again, obviously, the higher the gross return and the higher the tax rate, the higher the value of the tax deferral, right? So again, if you're in a higher tax bracket, this is going to benefit you a lot more. And if you're investing in higher earning assets, this is going to also benefit you a lot more. So now let's go ahead and talk about the problem with retirement and target date funds. And the main crux of the issue is that they heavily allocate to bonds. And we've shown in this presentation, bonds have lower gross returns and higher after-tax returns. And higher taxes. So you're getting less on an after-tax basis. Again, I'm going to just use a simplistic example. We're going to use John Smith. He's 52 and plans to retire in 13 years at age 65 in 2035. His retirement portfolio is all invested in a low-cost Vanguard target date retirement 2035 fund. The fund expense is only 8 basis points, so it's low. The expenses are low. That's great. But when we look at the allocation, we can see it's about 70% in stocks and about 30% in bonds. And as we talked about, this is going to be, the bond portion is going to be lower earning and less tax efficient than the stock portion. And so, it's not just Vanguard that does this. It's, most target date funds, if you look at your, 401k plans, your retirement models, as you get older, the retirement plan allocates a larger portion to bonds because they don't want the volatility of stocks. However, as we'll be showing later in the presentation, there's a way of investing in stocks and withdrawing money that's actually better for the client. So again, let's kind of look at why is increasing allocation to bonds a problem as clients near retirement. The first is to understand that to see what the typical stock versus bond allocations are by age. So here on the x-axis, we have the age of the client. We're starting at 20 and going to 100. Here on the y-axis, we have the percentage of allocation of the stock in stocks. So blue is again stocks. Orange are bonds. We can see when you're 20, it's 100% stocks. 30, it's about 90. 40, about 80. So you can see the stock percentage is decreasing until you get into retirement. And, around retirement, you're about a 60% stocks, 40% bonds portfolio. So the overarching message here is that as clients get older, financial advisors and target date funds allocate a larger percent of the portfolio to bonds to protect clients from the volatility of the equity markets, right? And the idea here is that when you're in retirement, they don't want you invested in something that has huge ups and downs, as we saw with the stock market, because you're taking out money, you're withdrawing money at that time. But there are better ways to kind of create portfolio solutions than in increasing the allocation of a portfolio to a lower yielding asset that is also more taxable, right? So again, bonds have lower expected long-term returns than stocks. Bonds are more tax inefficient than stocks, and bonds will continue to experience losses if interest rates rise more than expected. So bonds are not a pure, a guarantee, against loss, right? As in a rising interest rate environment, if anyone's in 2022 looking at their portfolio returns, you'll notice that bonds have taken, heavy losses this year. So the other key problem with allocating to bonds in retirement is what's called the effect of rebalancing. Rebalancing essentially means that at the end of each year, the portfolio manager looks at the percentage of the assets in stocks and the percentage in bonds, and they want to keep that percentage at a certain rate, right? They don't want the growth. They don't want the either side to grow too much, because then the portfolio will be unbalanced. So we're going to essentially look at a financial advisor with a client who has $1 million. They're looking at they want a 60% stock portfolio and a 40% bond portfolio in their portfolio allocation. So if the stock portfolio essentially grows too fast, what they're going to have to do is sell some of the stock portfolio and invest in lower earning bonds. And you can just imagine that, before we actually get into the math, how if I'm selling a good performing asset, to invest in a lower yielding, more taxable asset, how that's going to hurt clients over the long run. And we'll take a look at that here in this example. So again, at the start of the year, the client has $1 million. These are their tax rates. Again, we can see that the tax rates for bonds are significantly higher than the tax rate for equity markets. The start of the year, they want that 60% portfolio, 60% in stocks and 40% in bonds. So it's going to be $600K to stocks and $400K to bonds. Here's the $600K in stocks and $400K to bonds. We're assuming that the stock grows at 8%. Again, we're assuming that that's tax deferred, right? You can defer most of these gains. The bond growth we're assuming is at 3.5%, but that's taxable every year. So as we're going to see in the example below, the stocks are going to grow at a faster rate. But because the stocks are growing at a faster rate, and the portfolio manager wants to maintain the 60% stock portfolio to 40% bond portfolio ratio, they're going to have to sell stocks to invest in bonds, and the taxable outcome is going to hurt clients here, as we'll see in a second. So again, the starting value for stocks is $600K. The starting value for bonds is $400K. So if this is making 8%, so 8% on the $600,000 is $48,000, right? If the bonds are making 3.5%, that's $14,000 on this $400K. So we can immediately see the gross return is a lot higher, right, on the stocks than the bonds, is what we expected. The next thing is we have to consider taxes, right? Well, what's going to happen with taxes is, like we said, when you invest in stocks, most of this is going to be tax deferred. So we're looking at that you're not really paying taxes on this 8%. So there's zero taxes due here. Whereas in this case, on the bond side of the portfolio, it's $14K in gross gains, but then it's subject to this tax rate. It's subject to this 45.1% tax rate. So you're losing that amount. So now you have, when you add the 14, you have to subtract the taxes you pay on it. So the net gain is about $7,000, or almost 7.7. So you add that 7.7, and so this bond portfolio has 407.7, whereas the stock portfolio has the full 648, right? There's no taxes here owed. The issue, though, is that let's do our percentages again. Now I have $648,000 invested in stocks and $407,000 or $408,000 almost in bonds. Now my portfolio, the percentages are off, right? It's not 60-40 anymore. It's 61.4 in stocks and 38.6% in bonds. So now it's overweighted in stocks. So now what does the portfolio manager do? Well, they have to say, wait a minute, like I want to reduce my allocation to stocks and increase my allocation to bonds, which means then I have to sell some of the assets in the stock portfolio. So what they're going to do is they're essentially going to sell $18.2 million, or sorry, not $1 million, $18,000 worth of stocks. And they're going to sell $18,000 worth of stocks, and they're going to buy $18 million worth of bonds. However, by doing this, you're paying taxes, right? You're essentially, when you sell an asset, you're paying taxes on the gain. So before, when you were just deferring it, you weren't paying any taxes. But now that you've actually sold it, there's rebalancing taxes due here, right? So you're paying taxes on the gains. And yes, it's the lower 33%, but you're still paying taxes, and that's a drag. So you're not getting the benefit of deferral. So again, you're selling 18, but then you're paying 6 in taxes, so you're adding about 12 to the bond portfolio. So now it's going from 407 to 419. And then again, this is going down by the full 18. You sold the 18 here. So now it's from 648 to 629. But now I'm in alignment. Right now, the financial advisor is like, I'm back to my 60% portfolio and 40% bonds, right? I'm maintaining my 60%, 40% ratio. So this is essentially rebalancing, and you can immediately see the problem, right? Like, I'm selling a higher earning asset to invest in a lower yielding asset, and I'm paying more taxes for doing it. So the key thing that I want people to take away from this slide is that rebalancing away from higher earning tax efficient stocks to lower earning tax inefficient bonds actually reduces wealth over the long term because of both the drag of taxes and the lower yielding return of bonds. Next, I want to talk about the value of financial advisors, right? So financial advisors can provide either immense value or immense expense, and it's really dependent on what that financial advisor is providing you relative to the fee. So in this slide, we're going to look at a couple of things, a financial advisor versus managing your own investments, and compare the fees, and then we'll talk about value. So the three different fee structures we're going to be talking about is the management fee, the custodian or platform fee, and then the underlying fund manager fee or expense ratio of the fund. So we can see what a financial advisory firm typically charges you a management fee or advisory fee of about 1%. So if you're giving them $1 million, they're charging you 1% or about $10,000 a year just to provide advice for that. The next thing is the custodian fee. So typically, financial advisors will have the assets custodied or, at a certain bank or institution, and that institution charges a fee, roughly around 10 basis points. The next fee is the underlying fund fee or expense ratio of the fund. So the advisor is just charging you a fee to advise the assets, but he's not actually managing the underlying funds. He's allocating you to a fund. And those funds have fees. Those fees are typically about 0.3% to 0.5%. So when you look at the all-in fees, it's about 1.4% to 1.6% of using a financial advisor. So now let's kind of look at the fees of, whether if you do it yourself or self-advised, right? So there's no management fee because you're doing it yourself. You're opening up your own brokerage account at Vanguard or Schwab or Fidelity, and there's no, custody platform or kind of commissions associated with that. The underlying expense ratio of the funds, the fund manager, are really low. So that's one of the benefits of using, these options, Vanguard, Schwab, or Fidelity, right? So the expense ratios are really low. So when you just compare expenses, you can immediately see that the total all-in cost for the financial advisor is a lot more, multiples more than, doing it yourself. However, that doesn't mean that everyone should go to a financial or everyone should manage their own investments, simply because that presumption assumes that the financial advisor has no value, is not providing value in relation to this fee. So it's really important to understand what is the value the financial advisor is providing, and if they are, because not all financial advisors are providing the fee. If they are just simply taking your money and dumping you into the same funds that you could invest in by yourself at Vanguard or Schwab or Fidelity, then they, by all means, are not deserving of the fee, right? If they're not coming up with creative solutions to help you minimize taxes and maximize wealth, and working with you kind of to devise strategies, again, not really worth the fee. So the key thing I'd like you to take away from here is that, adequate financial planning and advising can add immense value, but it can also be a huge expense. So it really depends on what that individual firm is providing for you and your ability to evaluate their value proposition. And I especially mention this because not all financial advisors provide equal value relative to their fees, right? So a lot of financial advisors are simply salesmen. They're selling services as opposed to really strong financial planners or investment advisors. And it's important to try to understand which is which, right? But it's very hard to do if you don't have much financial background or literacy or education. And that's why it's important, just to get a level of understanding so you can evaluate who is providing what value. And you're not just choosing a financial advisor based on comfort or trust or what their website looks like or simplistic things that the financial advisor makes you feel about their service, right? There has to be a way for you to evaluate the actual value proposition that they're providing. And the other thing to think about is, everyone thinks that they can do it themselves, right? I'm just going to go to Vanguard, and again, because the expenses are a lot less, but that again presumes that you have the knowledge that is equivalent of the financial advisory firm. And while not financial advisors provide the same quality of advice, that doesn't mean you can kind of provide that level of a high quality financial advisor. So So the question to really ask yourself is, do you want to spend hundreds to thousands of hours learning all the ins and outs of the financial advisory industry, or do you want to pay a fee for a qualified firm to kind of handle some of this stuff for you, to help you devise strategies, to help you understand, risk tolerance? So the next thing I kind of want to talk about here is we talked about how, the allocation to bonds as clients get near to retirement doesn't make a lot of sense for clients. So I'm going to do a deeper dive here in showing you why on an after-tax, after advisory fee basis, it really doesn't make sense for clients, especially, as most financial advisors and retirement funds are going to that 60-40 type portfolio. So we're going to look at, the gross returns of stocks and bonds, and then we're going to look at taxes. We're going to look at all the fees, and then we're going to see what's the net return for the client, for stocks and bonds, right? So stocks, again, we're making an assumption of 8%. I know the long-term return is around 10%, but this is a little bit conservative. Bonds right now are about 3.5%. And here's taxes on this. So we can see the after-tax returns right before fees is 5.35, 1.91. Again, the wealth manager is charging 1% on these assets, and we can immediately see there's an issue here because stocks are doing well, on an after-tax basis. But so the fee is not that large relative to this. But on the bond side, on an after-tax basis, the fee is more than half of the after-tax return, right? And then there's a fund manager fee and underlying, again, the expense ratio of the funds. So the stock fund fee is going to have a fund. Again, it's not a Vanguard fund if you're using a financial advisor, right? So 0.5% and 0.25%. These are the assumptions here. Again, the platform or custodian fee. And then we have inflation, right? Again, right now inflation is really high, but long-term inflation is around 2%. So when we subtract all these expenses and costs, we can see that the net return to the client on the stock side of the portfolio is only about 1.5%, but on the bond side, it's actually negative. So this is another reason why a heavy allocation to bonds as you near retirement, especially if you're using a financial advisor to do this, doesn't make a lot of sense. So the after taxes, fees, and inflation bond returns result in negative returns for clients. So if you're really looking, financial advice can provide a lot of value, but they need to implement strategies that account for this, that provide better stability than bonds, that provide better after-tax returns and better ways to pass on wealth. So just quickly, I want to talk about, if in these last few slides, we've seen that, using bonds in retirements don't really make a lot of sense for clients. So why do retirement models, why do financial advisors use this strategy of increasing the allocation to bonds if they're lower earning and tax inefficient? And the real core of the reason is that this kind of practice, this model makes a lot of sense for financial advisors because it's simple. It's easy enough for them to allocate a certain percentage to stocks and bonds and call it a day. They can easily rebalance it. They can easily say, okay, we're moving it as you get closer to retirement, we're moving it into a safer asset allocation, and it makes their job easier, and it's easier for them to scale. And there are values to bonds, right? The bonds are less volatile than stocks, right? So it helps reduce the volatility of your portfolio by including that. Especially as you're entering retirement and clients are making withdrawals, right? Because there's something called sequence of return risk that if you're taking losses while you're making withdrawals, your portfolio can really deplete. And so using bonds can help, prevent this or limit the sequence of return risk. So that's kind of why financial advisors kind of increase the allocation of bonds. Is one, it makes their job easy. And two, it helps reduce the sequence of return risk and reduces the volatility. Another key reason is that clients worry more when they see losses than when they see gains. So especially if you're in retirement, you're really sensitive to losses in your portfolio than if you're in your 20s or 30s and you have a long horizon. However, that doesn't mean that bonds are really make the best sense or they're the best solution to accomplish the same goals. So one of the things you really should be thinking about as in retirement is how can I implement better risk-adjusted and tax-efficient retirement solutions, right? So instead of bonds, what can I do to reduce volatility, to minimize taxes, to increase after-tax returns, right? So a couple solutions we'll be talking about in the next sections of this presentation are retirement solutions. In place of bonds, what can we do to protect against volatility and minimize taxes? So we'll be talking about two things. One is protected investing and portfolio borrowing against your portfolio. So protected investing simply allows the clients the ability to protect against losses and get tax deferred or tax-free growth in place of giving up part of the upside. So what that really means is that protected investing can protect you against losses. So you don't have to worry so much about losing money. However, in exchange for protecting you against losses, you're also giving up a part of the upside, right? So you're not getting 100% of the upside when the stock market or when your investment does well. And that's kind of the trade-off, right? You're getting protected against the downside, but you're giving up part of the upside. So what that does, though, is it limits the volatility. Remember, we talked about how bonds can limit volatility. Well, protected investing will actually show you does that better, especially when we look at it on an after-tax basis, because protected investing has a lot of tax benefits that simple allocation to bonds does not. The next thing we'll be talking about is essentially borrowing against your portfolio instead of taking taxable withdrawals. One of the things we saw about, especially when we were doing the rebalancing, was that when you rebalance, you're paying taxes just to allocate money from stocks to bonds, right? You're taking away from a higher earning assets, you're paying taxes, and you're losing the ability of tax deferral. So the next thing we'll be talking about is why borrowing at low levels and at low interest rates against your portfolio allows investors the ability to invest in higher yielding equity assets without really paying large amounts of taxes, which then allows clients the ability to pass on more wealth tax-free to beneficiaries. So I'm just going to use a quick example. Again, we'll dive into this more later on in the presentation. Which of the two options would you rather do? Invest in a portfolio making 6%, in which you pay 30% to 40% taxes each year on the gains? Or would you invest in a portfolio making 8% that maximizes the benefit of compounding due to minimal taxes owed? And if you do need liquidity and to pull money out, you can borrow at low interest rates, which are significantly less than the 8% that it's compounding at. We'll go on into deeper detail later on in the presentation, but these are two important things to consider, both protected investing and borrowing against your portfolio or utilizing margin. Okay, so in this section of the presentation, we'll be talking about what is protected investing and why is it a better retirement solution than using bonds. Again, this is part 3 of 4 of our presentation, in our presentation on how do I increase my risk-adjusted portfolio returns and minimize taxes as I plan for retirement. So let's kind of just jump right in. What is protected investing? Protected investing is simply protecting against losses on your portfolio return while getting most of the upside. So just let's summarize a couple key characteristics of it. Is when you're utilizing protected investing vehicles, you are protected against losses in exchange for giving up a share of the upside. So again, whenever you get a benefit, there's a cost to it, and that's the cost, right? But the upside here is you're reducing the volatility. Also, the returns are either tax-free or tax-deferred. So you're getting multiple benefits in exchange for giving up some of the upside. You're making the vehicle itself or the returns more tax-efficient. And again, you're protecting against volatility from protecting against losses. So now let's kind of just quickly talk about what are some examples of protected investing. What vehicles are they? And here's just a list of a couple of them, right? No commission annuities, multi-year guaranteed annuities, whole life insurance, indexed universal life, and structured notes. So now I'm just going to use an example of one of these vehicles, the indexed universal life. Where how it works is you get a part of you get a part of the index return subject to a spread. So in this case, you're getting the return minus 8%, and it's floored at 0%. So you're not getting any of the losses. So we're just going to look at examples of what you'd be earning here. And again, these are kind of hypothetical. So here's your S&P total return for year 1. It's 14%. If we subtract the 8% spread, you're getting 6%. Year 2 is 4%. We subtract the 8% spread, that's negative, so it's floored at 0. You're getting a 0% return. So again, you're protected from losses. Next year is a negative 30%, a huge drawdown, but you're not taking any of the losses. Again, it's floored at 0. Year 4 is 25, the 8% spread, you're getting 17. Year 5 is 9, you're getting 1. So we can see here the downside is that you're not getting the full upside here of the S&P, but you're protected against losses. So what this is doing is reducing volatility. And the other thing, the benefit of the IUL is that they make these returns tax-free. So again, you're giving up something, you're giving up part of the upside, but you're getting less volatility and more tax efficiency. And we'll see how that translates in relation to bonds, in the next few slides here. So now let's compare, right? Let's compare, stocks, protected investing, and bonds. Again, we should be familiar with this from the previous presentation. The blue line is S&P return, your equity. The red line are your bonds, and then the orange are your protected index return. Now, a key thing with this chart is that it's after-tax returns, right? Because we're, in the previous slides, we just talked about pre-tax returns, but one of the real benefits of protected investing is you get tax deferral benefits or tax-free benefits. In the case of the IUL, you're getting, that we saw before, you're getting tax-free return. So let's kind of look at it quickly. We'll compare the protected investing to the equity market, and then we'll compare it to bonds in a second. So with regards to the equity market, again, here's the blue line. We can see that it tracks very closely, right? So the correlation is high. But what are we seeing here? We're seeing that when the S&P is negative, the protected investing, it's floored at zero. You're getting zero, and it's less. And then in most years in which it's positive, right, the protected investing is less than the equity return. And we see that for most cases. You might say, hey, Rajiv, I'm noticing in a couple of years, the protected investing is actually higher than the equity investing. And that's because of the tax savings. Remember, the protected investing, you're getting tax-free returns. So even though it's a spread of what we assumed was 8%, that spread is not nearly as much as the tax savings. So in certain years, the IUL is actually outperforming the equity returns. We can see that here in 2013 and 2019. So we can quickly see that it's a high correlation, obviously, to the S&P or the equity markets, but it has advantages in that it's protecting you for the loss, right? Like in 2008, you're not experiencing the loss here. And in certain years, you're actually doing better. However, when we compare it to the bond index or the AG, we can see that it drastically outperforms it, right? So because you're getting floored at zero, but you're getting a lot of the upside of the equity markets. So again, it's reducing the volatility and making it more tax efficient than bonds. And we'll see that when we look at the after-tax returns in this chart on the right. So this, again, this table should be familiar. We looked at it on a pre-tax basis on the previous slides, where we have, again, stocks, which is the VU. That's the benchmark. The protected index is the IUL, and then bonds, we're using the AG. Again, we're going to look at the pre-tax return, the after-tax return, and then the after-tax volatility and after-tax Sortino ratios. So again, from 2002 to 2021, stocks, again, did well. Compound annual return of 9.33. Protected index, the pre-tax return is 7.94, and bonds were 4.15. Well, now let's look at on an after-tax basis. Again, we're still using that married couple, making about $450K a year. So we can see that on an after-tax, this is about 6.61%. The protected index is actually the same, right? Because as we talked about, the pre-tax and the after-tax are the same because it's tax-free. The returns are tax-free. So in this case, from 2002 to 2021, the protected index actually beat the stock market on an after-tax basis. And we'll talk about in a second why that's unusual. But if you actually look at it that way, that's the actual after-tax return. Bonds, on the other hand, when we look at the after-tax, again, tax inefficient. Again, you're not really making a whole lot off bonds. And if you're, again, have a financial advisor charging their fee on top of this, you're making even less. And the next thing to take into consideration is the volatility. How volatile are these returns on an after-tax basis? We can see that, again, for stocks, it's fairly high. The protected index, it's also relatively high, not as high as the equity market, but definitely a lot higher than bonds. But when we look at our return to risk ratio or our after-tax Sortino ratio, we can see that of the three, the protected index has the best after-tax return to risk ratio. And that's why, it makes protected investing can make a lot of sense for your portfolio because, again, it's protecting against the downside and it's making it more tax efficient. So if you're really looking for a holistic portfolio solution, using protected investing in place of bonds makes a lot of sense. Again, just to summarize, protected investing provides greater risk-adjusted after-tax returns than bonds. I will mention here, you might be realizing, wait a minute, protected investing is greater than equity markets, and that's actually not the case in the long term. The only reason that during this period, protected index or investing outperformed equity markets on an after-tax basis is simply because of 2008, right? Like, there's such a huge drawdown that it hurt the returns here. But if you actually simulate results, we'll see that in the next slide. What you can expect is that stocks are going to have the highest risk to return or return. Next is protected index, and then bonds will be last. So we're going to see that in the next slide. Again, this is based on simulations, not on any historical time period. Again, we're going to use the assumption stocks are about 10%. That's kind of the long-term return profile of stocks. We're going to look at the compound 30-year pre-tax return. The protected index, again, it's only about 4.38%. Bonds, we're using about a 3.5% assumption. And then when we look at the after-tax, compound annual after-tax, we can see that stocks are about 6.98%. Again, protected index, the after-tax returns are the same, right? Because it's a tax-free vehicle. Bonds, again, you're not really making a whole lot on an after-tax basis. When we look at the 30-year after-tax volatility, right? After 30 years, the volatility is lowest, obviously, for bonds, right? You're not going to see it's going to be within this kind of mean of 1.58%. So that it has the lowest volatility bonds, but protected index returns are, again, the volatility is not as low as bonds, but lower than the equity market. And when we look at our return relative to risk ratio, our after-tax ratio, again, stocks outperform, but using protected index vehicle is going to vastly outperform bonds. So again, over the long term, equities should provide better value than protected index investing in bonds, but protected index investing or protected investing is going to be a better solution for portfolios than utilizing bonds as you get nearer to retirement. So in this section of our presentation, we'll be talking about how can borrowing against my portfolio, instead of using taxable withdrawals, generate more wealth for both myself and my beneficiaries. Again, this is part 4 of our presentation on how do I increase my risk-adjusted portfolio returns and minimize taxes as I plan for retirement. If you haven't seen the previous sections of this presentation, I'll include links down below. So let's kind of jump right into it. In order to understand why borrowing against your investment portfolio instead of utilizing taxable withdrawals is better, we first need to understand, the step up in basis provision and how we can use this provision to pass wealth on tax-free to the next generation. Now, step up in basis is a provision that's allowed wealthy individuals to pass on wealth tax-free for decades now. So step up in basis is a provision which allows married couples the ability to pass $24 million to beneficiaries tax-free if they pass on these assets to beneficiaries through death. So their beneficiaries inherit these assets upon death of the last married couple or married individual. Again, if you're single, you can still pass on wealth, but not as much. It's about half this, right? Since it's only one person. But this is the benefit of step up in basis. If you're looking to generate generational wealth or pass on as much assets as you can to your kids, you want to use this provision to pass on wealth. So the benefit of utilizing both step up in basis as well as borrowing against your portfolio is that it allows individuals or married couples the ability to invest for the long term and have beneficiaries inherit the majority of the gains tax-free, while also allowing the retirement couple the ability to borrow against it at low rates if they need it. So if the married couple or single individual is in retirement, they need money, they can always borrow against the portfolio. But if you're really looking to generate generational wealth and pass on as much wealth as possible, you want to, again, minimize the tax drag on it. And using step up in basis to pass on millions of dollars tax-free is a great way to do it. So I know this sounds a little bit complicated, so I'm going to kind of use an example just to kind of highlight how it works and why you want to pass on assets to the next generation tax-free through step up in basis, as opposed to, selling assets, and what the difference is, right? Again, we're going to look at, a couple, one individual wants to pass on assets after death. They want to use the step up in basis provision, and another individual wants to invest for a certain period and then sell assets and give it to their kids. And we're going to see the vast difference in those two approaches. So here's our hypothetical example. John and Sally Smith are both 50-year-old high net worth individuals in California who combined make $450,000 a year and are at a 33.1% marginal tax bracket. Both John and Sally take $25,000 of each of their after-tax salary, and they invest it in a growth equity index fund through a Vanguard taxable brokerage account. And they're using Vanguard because, again, it's a low cost, like we talked about, low expense ratios. The fund does not pay any dividends, right? So it's a growth fund, no dividends. You're only getting the capital appreciation, and it grows at 8% a year. Both John and Sally invest their $25,000 for 30 years. So they put it in, on day one when they're 50, and they invest for 30 years. At the end of 30 years, John sells his investments and gives the net proceeds to his son, right? So he put the $25,000 in, he invests it for 30 years, and then at the end of 30 years, he sells it and gives the net proceeds to his son. Sally, on the other hand, wants to invest for the long term and use the step up in basis provision. So at the end of 30 years, Sally dies and her son inherits the net proceeds. So the question I want to ask here is, well, which parent loved their son more? And we're going to show you, which parent in this quick mathematical example. So John, again, he invests the $25,000. It grows at 8% a year, and it's compounding for 30 years. It grows to $251,566. Again, this is subject to a 33.1% tax rate. So after the taxes, John receives $176,573, and then gives that amount to his son. He just gifts it. So that's what his son receives. However, Sally, because she passed on the assets through death and utilized the step up in base provision, again, that $25K still grows to $251,000. But however, due to step up in basis, the son inherits the assets. So there's no paying taxes and then gifting. So the son inherits the whole $251,000 tax-free. So again, the answer to which parent loved their son more is Sally, because Sally smartly realized that she could pass on more wealth simply by investing for the long term and not selling those assets, right? And paying the large tax drag. Step up in basis allows individuals' ability to bypass taxes when passing on wealth to the next generation. So let's talk about some highlights here about why should you borrow against your security portfolio instead of selling securities and paying taxes on the gains. Obviously, we saw the answer in the previous slide, but a couple of quick pointers or highlights here. Borrowing against your security portfolio allows for the ability to pass on wealth tax-free, again, through step up in basis, while also providing liquidity. You can borrow against it, the same way you can borrow against your house, or we'll talk about that in a second here. In fact, borrowing against your security portfolio is a lot cheaper, and the rates are a lot less than current refinancing rates. Again, you can borrow up to 70% of the collateral value of your portfolio. So again, it's not as high as borrowing against your house, because there you can do about 80%, but it's pretty close. And similar to a mortgage, right? The interest is deductible. If you pay the interest on that at the end of the year, within the year, that interest is actually deductible. But probably the most important ability is that the fact that when you sell securities, you pay taxes, just like we saw in the previous slide, and that reduces wealth. And so just quickly, when we're talking about rates here, we talked about rates being significantly less than refinancing rates. I just wanted to quickly show you some rates. Again, this is as of May 28th, but margin rates are about 1.5 to 2%. Again, you can borrow about 70% of your portfolio through margin. Whereas if you look at 15-year refinance or 30-year finance rates, yeah, you can borrow a lot, or not a lot more, but 80%, so 10% more. But look at how much higher the rates are, right, relative to borrowing against your portfolio. So you're borrowing against your portfolio, you're not paying taxes. And, as you can imagine, if you're doing that, and your portfolio is making more than what you're borrowing at, you can see how this benefits individuals in accumulating wealth. So a couple of quick tips when you're borrowing against stocks, you don't want to borrow the maximum amount. Obviously, we talked about how you can borrow up to 70%, but you don't want to borrow the maximum amount, because what happens is if there's a drop in the value of your stock portfolio, let's say, the stock portfolio drops by, you borrowed the maximum amount, your stock portfolio drops by 20%, then what happens is the lender can sell some of your stocks to make sure that that cushion is still 70%. And so you don't want that to happen. You don't want the stock market to have a short-term drop and then essentially the lender to sell your stock portfolio when it's at when it's low, because essentially they're selling it low, right? So what you want to do is you want to leave a cushion, right? So you don't want to borrow the maximum 70%. Again, 30% to 50% is a decent range, and you probably don't even need to borrow that much. And we'll talk about that in the next slide. But you do want to leave a cushion. Don't borrow the maximum amount. And again, you want to borrow, when you're borrowing, you're not borrowing against individual stocks. You're borrowing against an index fund, right, which is a lot more stable and less volatile than individual stocks. You don't want your entire investment portfolio to be one stock position, right? Otherwise, that's super risky. Again, as the equity market goes up, like as the value of your portfolio goes up, that means you have more cushion so that you can consider borrowing more if you want to. Paying off the margin interest every year allows you to get the tax deduction for doing so. So here's just some quick tips. So now in the next few slides, I really want to show you the vast advantage that comes with using 100% equity portfolio with portfolio borrowing in retirement, or margin borrowing, as opposed to the traditional 60-40 retirement portfolio that comes with taxable withdrawals. So it's going to be, like we talked about, it's going to be lower earning, right? Because you have a heavier bond allocation, and the taxes are going to create a drag, right? Especially since you have the rebalancing here. So let's kind of just do a high-level comparison between the two strategies. Again, here's the first strategy: 100% equity portfolio with portfolio borrowing versus a 60-40 portfolio with taxable yearly withdrawals. So we're going to compare two things: the long-term gross returns and the estimated taxes. So here, of course, the long-term expected gross returns are going to be higher, right? Because it's invested in pure equities, 100% equities. And there's also a low cost of borrowing, right? So as we'll show, we saw on the previous slide. So the long-term gross returns are going to be a lot higher here, and we'll dive into that on the next slide. Versus the 60-40 portfolio, which is only in 60% stocks and then 40% bonds, which is dragging the gross returns down. On top of that, the taxes, the percent of the earnings that are lost to taxes are going to be really low here, because it's a 100% equity portfolio. And again, as we talked about, stocks have the benefit of tax deferral. You get the step up in basis, right, where you can pay almost zero taxes if you don't sell any of the gains or sell any of your positions. Versus the 60-40 portfolio, again, in order to get your distributions, you're doing taxable withdrawals. And if you're a higher earner, you're paying 30% to 40% of that in taxes, if not more. So just to summarize, 100% equity portfolio has higher long-term gross returns and lower taxation, significantly lower taxation. So the after-tax returns are significantly better. So you're building a lot more wealth by using 100% equity portfolio with portfolio borrowing, both for you as well as for your beneficiaries. And we'll dive into that in an example in the next few slides. So again, let's look at a case example here, just to show you the real benefit of this 100% equity portfolio with portfolio borrowing versus a traditional 60-40 retirement portfolio with taxable withdrawals. So again, our case couple here is John and Sally Smith. They're both 55-year-olds in California looking to retire early. Each have $2 million for retirement. John wants to do the 100% equity portfolio using margin borrowing or portfolio borrowing. Again, we're going to assume it's 2% cost of that borrowing for retirement spending. So John is not going to have any taxable distributions. He's just going to borrow against his portfolio at a 2%, a low rate. However, Sally, wants to do something else. She wants to go with the traditional 60-40 retirement portfolio and use taxable withdrawals, right? That's what, everybody else is doing. That's what financial advisors, are recommending she does, and she wants to go ahead and do that. For our assumptions here, we're going to say that the equity portfolio is at 8% and the bond portfolio is at 3.5%. So we can immediately see, right, if I have 100% of 8%, that portfolio is going to be earning a lot more than if I do a blend of 60% of 8% and 40% of 3.5, right? So again, the withdrawal rate is going to be 4% each year, right? So both have $2 million. So both are going to take out $80,000 with increases for inflation. We're using a 2% assumption here. The difference, obviously, is John is borrowing it, so there's no taxable withdrawals, versus Sally is, again, taking taxable withdrawals. So again, the assumptions here is that the long-term capital gains tax rate is 20%. The ordinary income tax rate is 26%. So we're going to use the assumption that both live 30 years and then die. So the question we're going to be asking is, again, who loves their son more? Because their son will inherit what's left over. So we're going to see that in the next slide here. So at the end of 30 years, John leaves $21.7 million to his son, right? Because that $2 million was growing at 8% compounded. And he was borrowing at 2%. However, Sally, on the other hand, only leaves $2.4 million to their son, rather. So John's after-tax return is 9.68%. So you might be saying, wait a minute, Rajiv, like it was 100% equity portfolio, but that was only earning 8%. So how is his after-tax return 9.68%? And the reason is that he was borrowing against it at 2%, right? So by borrowing against it, it allowed him to utilize the benefit of leverage, right? So and tax deferral. We talked about the benefit of tax deferral, of not having having that 8% be compounded. Sally, on the other hand, her after-tax return is significantly less, right? Because again, first of all, her gross returns were less because she was in a 60-40 portfolio. So her after-tax return is only 5.55%. So in this scenario, John clearly loves his son significantly more than Sally, because John was prudent in his financial planning and how to use financial tools to advance his objectives, right? Of making sure that he has enough withdrawals for retirement, as well as maximizing the amount he's able to give to his son at death, again, through the step up in basis provision, right? So John, again, doesn't, has the benefit of just, not paying much in taxes, as well as using the step up in basis provision to pass on a majority of the wealth to his son. So again, utilizing financial planning tools to advance an objective here. So the 100% equity portfolio has higher long-term gross returns and lower taxation, while you're borrowing retirement spending instead of using taxable withdrawals. So the after-tax returns are significantly higher. Again, you're using the benefit of leverage as well as compound returns. Well, you might be saying, well, Rajiv, what if I do need to take taxable withdrawals, or I want to make taxable withdrawals? What is the best way to do that with my stock investment portfolio? So again, a cool thing about long-term capital gains is that if that you can pay 0% in taxes in retirement. You just have to plan it properly. So long-term capital gains tax rate is 0% up to $109,000 worth of income, and that's again in today's time. This will probably change in the future, but the key thing is, again, you can't have any other income besides what's coming at what you're withdrawing from your portfolio. But if you have $109,000 of long-term capital gains and that's your only income, you can take that essentially out tax-free. So the way to think about that is you have to think about that in the context of your tax bracket. So we're going to look at a high income earner. This is the marginal ordinary income tax rate by age with optimal planning. Okay, when this individual is working, let's say they're working until 60, they're in the highest tax bracket. Let's say it's 50%. But immediately after they stop working, their tax bracket, again, especially if they're in an all equity portfolio, that doesn't really pay dividends, it drops to close to 0%, right? They're not making any income, and they're not taking any Social Security, right? So there's an opportunity here before they start taking Social Security or have RMDs from any IRAs that their tax bracket is going to be really, really, really low. So the goal here in your planning is if you do want to pay to do taxable withdrawals is immediately after you retire is use this 0% tax rate up to $109,000 each year, again, before your Social Security kicks in and before your required minimum distributions kick in. So just to summarize here, proper planning can allow investors to both retire early and extend their retirement savings, right? Because again, you know, by limiting the your taxes on your gains, that's more that you have that you can withdraw in retirement and extend in case you live longer than expected, right? So that kind of summarizes our presentation here about how to maximize risk-adjusted portfolio returns and minimize taxes. Again, we do help RIAs and high net worth individuals with their planning. So if you thought this was informative and want more information or want to connect or see how we might be able to work together, feel free to reach out to us. Again, at our phone number or email is the best way to reach me. Again, my name is Rajiv Rebello. You can also visit our website at colvaservices.com.